offense wins games, but defense wins championships. This is a common phrase in the world of sports, where defense is considered crucial to a team's success. But you might be interested to know that defense also exists in the world of investing. It comes in the form of defensive stocks. And just like defense in sports, many investors consider defensive stocks important to their success, especially during market downturns. But just what is a defensive stock, and why might it be important during market downturns? A stock is considered defensive if its price is less sensitive to general market conditions. These companies often produce goods or services with consistent demand that doesn't rise or fall too much based on general economic conditions. For example, consider how much electricity you use. Your energy consumption isn't going to be the exact same from month to month, but it's not likely to change much. And you're not likely to adjust your consumption habits based on a change in economic conditions. Hydro and other utility companies are examples of defensive stocks because people need them during all phases of a business cycle. Let's dive into some data that shows how defensive stocks perform during past market downturns. This visual shows the 10 economic sectors that make up the S&P 500 and how they performed relative to the overall index during 8 separate market declines. The market declines spanned from the 1980s up until 2019, and each decline led to prices falling at least 15%. The green squares on the right indicate how many times out of the 8 declines each sector outperformed the S&P, and the gray squares on the left show the times the sector underperformed relative to the S&P. For example, the consumer staples and utility sectors at the top outperformed the market during all 8 of the market declines in this period. This means that their returns were higher than the overall S&P 500. Note that this doesn't mean defensive stock returns were positive during these declines. Next are the healthcare and telecom sectors, which outperformed the market 7 out of the 8 times. And if we shift our focus to the bottom of the chart, we see the opposite occurred. For example, the industrial sector underperformed 7 out of the 8 times and only outperformed the market once. A similar scenario occurred with the financials, consumer discretionary, and information technology sectors, which outperformed twice and underperformed 6 times. The key takeaway from this data is that some sectors have historically performed better than others during economic declines. But there's a caveat to keep in mind when going defensive. While they may have historically performed better during market downturns, they may also underperform during bull markets. Also, historical data does not guarantee future results. That said, investors who are more aware of how different companies perform during different environments may make better informed decisions. Consideration should be given to portfolio mix based on whether the market is transitioning in or out of declines. If you'd like to see more content on weathering a recession, check out our video on how falling markets lead to rising opportunity. Thanks for watching.